Imagine a high net worth client, right?
Yeah.
Like a billionaire. And they call up their private banker.
Okay, setting the scene.
Yeah, exactly. So they're standing on the docks in Monaco. They've just finished touring this massive super yacht, and they want to buy it on the spot.
As one does.
Right. And they tell their banker, hey, wire 5 million euros to this broker right now. Now, 20 years ago, that private banker might have just, recognized the client's voice, checked the account balance, and manually pushed the button.
Oh, easily. That was the standard of service.
But today,
yeah.
Legally, that banker has to say, I'm sorry, I actually can't do that for you. You need to hang up the phone, open our smartphone app, and authenticate the transaction yourself.
And you can imagine the client is probably furious in that moment.
Oh, absolutely livid. Because the entire allure of private banking is supposed to be, the total elimination of friction, right?
Right, but the bank has zero choice in the matter. I mean, the legal, technical, and regulatory machinery governing that single wire transfer it's absolute.
Welcome to the Deep Dive. Today, we're analyzing a pretty detailed breakdown of strong customer authentication protocols, or SCA.
Yeah, SCA is the acronym we'll be using a lot today.
Exactly. And we are pulling directly from legal texts and analytical sources about how these protocols apply specifically to the highly exclusive world of Luxembourg private banking.
It's a really unique intersection of worlds.
It is. Our mission today is basically to understand how these elite financial institutions balance that bespoke white-glove customer service with these ironclad, legally mandated security frameworks.
And the tension there is just fascinating because we aren't just talking about a bank's internal IT policy here or, a vague desire to be careful.
Right. It's not a suggestion.
Exactly. We're talking about strict statutory requirements. I mean, the central concept protecting digital wealth today is strong customer authentication.
But if an institution implements it clumsily, they alienate their most valuable clients.
Yeah, and if they implement it loosely to keep the clients happy, they're actively breaking the law.
So before we get into how banks actually, engineer their way out of that trap, we really need to define the legal boundaries.
The ground rules.
Right. What is actually forcing the bank to say no to that billionaire client on the docks in Monaco?
Well, the foundation we're looking at is Article 105-3 of the amended Luxembourg Law of 10 November 2009.
That's a mouthful.
It is. It's the law on payment services, electronic money institutions, and settlement finality. But for our purposes, we'll just refer to it as the Payment Services Law of 2009.
Okay, Payment Services Law of 2009. Got it.
So this piece of legislation creates the primary legal trigger. It basically mandates that SCA is legally required in 3 specific scenarios.
Which are?
When a payer accesses their account online, when they initiate an electronic payment transaction, or when they carry out any action through a remote channel, which might imply a risk of payment fraud.
Okay, wait. A law from 2009. I kind of have to challenge that time.
Okay, the year?
Yeah. I mean, the first iPhone was barely 2 years old in 2009. We didn't have Face ID. We barely had functional mobile banking apps.
That's true.
So how is a law that old dictating modern biometric retina scans or dynamic cryptographic tokens?
It's a great question, actually. And it works because the 2009 law was drafted specifically to be technologically neutral.
Oh, meaning it doesn't specify the hardware.
Exactly. It doesn't say use a smartphone facial scan. It establishes the legal philosophy, right?
Right.
If a digital risk exists, strong authentication must happen.
I see.
The actual technical blueprint, like the precise mechanism of how banks must do this, that came later. That was primarily with the Commission Delegated Regulation EU 2018/389 of 27 November 2017.
So SCA Delegated Regulation.
Yes, the SCA Delegated Regulation. And that regulation demands that authentication use at least 2 elements from 3 specific categories.
Let me guess. Knowledge, possession, and inherence.
You got it. The 2 out of 3 rule.
So basically the standard 2-factor authentication we all know. Like a password, that's knowledge. A smartphone you possess. Or a fingerprint that is inherently yours.
Right, inherence.
Most of us deal with that just to log into our email every day. But why is it so legally precarious when applied to a private bank? I mean, logging into an email is one thing, but moving millions in assets. I assume the technical requirement goes a bit deeper than a simple text message code.
Oh, considerably deeper. The stakes are astronomically higher here. And the regulation reflects that through a mandatory requirement called dynamic linking for remote electronic payments.
Dynamic linking. Okay, how does that differ from a normal login?
Well, you aren't just logging in. The authentication code generated for that specific transaction must be mathematically, cryptographically linked to the exact transaction amount and the specific payee.
Oh, wow. So how does that actually work under the hood?
So when you initiate that wire transfer for the yacht, the bank's back-end system generates a unique token. And that token is essentially a complex mathematical equation. The fixed variables in that equation are the amount, so 5 million euros, and the payee's exact account number.
Right.
If a hacker intersects your session in real time, what we call a man-in-the-middle attack, and they try to change the destination account or, alter the amount to 10 million.
The variables in the equation change.
Exactly. And the token instantly breaks.
Instantly.
The code fails to authenticate because that dynamic link to the original parameters is broken. The transaction is just hard stopped before a single cent leaves the bank.
That's incredibly secure. But if a system is that rigid, where a single altered variable kills the whole transaction, how do banks prevent the everyday banking experience from becoming just a total nightmare?
That's the million-dollar question.
Because if I have to generate a dynamic cryptographic token just to see if a check cleared, I'm pulling my money out of that bank.
Yeah, nobody wants that. And this is the core operational challenge this source material tackles. To survive this regulatory environment, institutions have to master specific operational controls.
Okay, what's the first control?
The foundational step is precise mapping. A bank cannot secure a digital architecture. It hasn't mapped down to the absolute last endpoint.
Let me try to visualize this.
Yeah.
It sounds a bit like installing a highly sophisticated home security system, right?
I like that. Go on.
You can't just slap a heavy padlock on the front door and call it a day. You have to wire every single window, every motion sensor, the garage door, the back gate, connecting them all back to a central alarm panel.
Right, you need total coverage.
And more importantly, the system needs to distinguish between your cat walking across the living room and a burglar breaking a window.
That is a much better way to think about it than just, a generic IT checklist. The bank is auditing API calls, mobile application interactions, card usage flows, even legacy mainframe systems.
Everything is connected.
Everything. They have to map out highly specific touch points, online account access, payment initiation, beneficiary management, and so on.
And they categorize the risk for each one.
Exactly. As your home security analogy suggests, the system has to differentiate the threat level. Simple account access, the cat walking by, is a completely different touch point than executing a transaction to a new overseas account, which is the broken window.
Because if someone breaches your account just to look at your balance, they've stolen your privacy.
Right.
But if they wire your money, they've stolen your actual assets.
Exactly. The legal liability and the authentication weight shift dramatically depending on the action.
So mapping is the key.
Yes. By mapping this architecture perfectly, the bank achieves two critical things at once. First, they ensure SCA triggers exactly when the law demands it, so they close all the security gaps.
Right.
But second, they carve out the safe zones where they don't need to introduce heavy friction for the client. If they wire the alarm system correctly, you can walk to your kitchen at 2 a.m. without setting off the sirens.
Okay, so they've wired the house perfectly. They know exactly where every digital door and window is. But what about the routine actions that do involve money?
Like what?
Like if I'm paying my monthly rent to the same landlord I've had for 3 years, forcing me through a full cryptographic dynamic linking routine for that seems absurd.
And the regulators agree. Which brings us to the governance of exemptions. The SCA delegated regulation recognizes that absolute rigidity just breaks commerce.
Yeah, nobody would be able to buy anything.
Right? So it outlines highly structured, legally permitted deviations.
Wait, legally permitted deviations? I'm going to push back on that phrasing a bit.
Oh.
That sounds like a very polite corporate way of saying legal loophole. If the law says you need strong authentication, but then gives you a list of times you don't, that is a loophole.
I get why you'd say that, but a loophole implies a flaw in the drafting that people exploit, to get around the spirit of the law.
Fair point.
These exemptions are deliberate, intentional, and extremely narrow. They are designed specifically to facilitate normal commerce without sacrificing security.
What kind of exemptions are we talking about?
They include trusted beneficiaries, so where you've previously authenticated a payee as safe. There are recurring payments, low-value transactions, secure corporate payment protocols, and my personal favorite, transaction risk analysis.
Oh, transaction risk analysis. That sounds intense.
It is. And these exemptions only operate at specific stages, like initiation or execution.
Let's look closer at that transaction risk analysis one. If I log in and make a payment, how is the bank deciding in real time whether I get an exemption or if I get hit with an authentication prompt?
It's all happening in milliseconds behind the scenes.
Sure.
The bank's algorithms are evaluating a massive data set the exact moment you initiate the action.
What kind of data?
They're looking at your device ID, your IP address, your geolocation. They even look at behavioral biometrics, like how you type or the angle you hold your phone.
Wait, really? The angle of my phone?
Yes, it's wild. And they compare all of that against your historical spending patterns. If the algorithm calculates that the fraud risk for this specific action is virtually zero, it grants the exemption and the payment goes through seamlessly.
So if you're listening to this and you've ever traveled abroad, tried to buy a coffee, and suddenly your card was declined or your app demanded a fingerprint scan.
Yep.
That is the transaction risk analysis algorithm at work. The computer couldn't mathematically justify the exemption because your geolocation suddenly changed to a new country.
That is the exact mechanism in action. But the bank's liability here is immense. If the system grants the exemption and the transaction turns out to be fraudulent, the bank is on the hook.
Because they chose not to verify.
Right. They made the decision to lower the shield. This is why the regulation demands incredibly detailed internal policies from these institutions. Strict eligibility criteria, complex decision trees, and above all, comprehensive audit trails.
Oh, the audit trails.
Yeah.
The digital paper trail proving to the regulators why the bank didn't use the heavy security.
Exactly. Regulators require the bank to capture the exact rationale, the data inputs, and the system decisions that supported the exemption. You need the digital receipts.
So you can't just guess.
No. If a regulator comes knocking or a client claims fraud, you cannot simply say, well, it looked like a safe transaction to us. You have to prove it mathematically.
Wow.
Furthermore, this isn't a static system. The source text heavily emphasizes continuous monitoring. Under the law, to use the risk analysis exemption, a bank must maintain an incredibly low overall fraud rate across their entire portfolio.
Let me make sure I understand the stakes there. If a bank's security gets sloppy and their overall fraud numbers creep up across the board, do they legally lose the privilege of offering that seamless experience to their clients?
Yes. They lose the exemption entirely until they fix their predictive models and bring the fraud rates back down.
So suddenly every transaction needs a fingerprint.
Exactly. Every single transaction suddenly requires full authentication. Their clients get furious at the constant friction, and the bank loses its competitive edge in the market. The continuous recalibration of these models against evolving fraud patterns is an absolute regulatory mandate.
Man, it is a massive technical balancing act. But, everything we've discussed so far, the API endpoints, the algorithmic risk analysis, the cryptographic tokens, it's all purely digital.
Right.
We are talking about Luxembourg private banking here. The entire allure of this sector is the bespoke human-to-human relationship. A high-net-worth individual isn't just interacting with an app. They have a dedicated relationship manager on speed dial.
And this is where the digital mandates of the Payment Services Law of 2009 crash into the very messy reality of human relationships.
Yeah, I was wondering about that.
We established earlier that a banker can't just take a phone order for a yacht anymore. The law requires strict frameworks around the involvement of relationship managers to ensure they do not become like a manual workaround to the digital security.
Which creates a fascinating tension, because the client pays premium fees for a concierge experience. They want to say, move the money, handle the paperwork, don't bother me.
Exactly.
Telling a billionaire, no, you have to log in, feels like terrible customer service. But doing it for them is a compliance disaster.
To navigate this, institutions must enforce a rigid segregation of duties. The person advising the client and helping them manage their wealth cannot be the person executing the payment instructions.
So what can the relationship manager actually do?
They can provide advisory support, they can prepare the orders, they can help set up the transaction in the system.
So they can do all the heavy lifting, the data entry, and the routing.
Yes, but they absolutely cannot replace or weaken the strong customer authentication required at the final point of initiation or confirmation. The banker cannot provide the possession or inherence elements on behalf of the client.
That makes sense. So how does a bank manage these assisted transactions safely? What are the actual rules of engagement for the relationship manager when a client calls with a demand?
The procedures must be explicit, documented, and tracked. First, the communication must happen over approved, secure channels.
So no WhatsApp.
Definitely no WhatsApp. You cannot accept a casual text message from a client to initiate a multi-million euro flow. Second, there must be strict traceability of the instructions and a formal verification of the client's intent.
Okay.
And crucially, any manual intervention by a relationship manager must be logged, thoroughly reviewed, and subject to the exact same authentication standards as a fully automated digital flow.
That is a profound point, actually. The human element doesn't get a free pass just because they are human. If anything, the manual flow should be scrutinized harder, right? Because humans are susceptible to social engineering and manipulation in a way that algorithms just aren't.
Exactly, which is why training is just as critical as the software architecture. The front office staff, the bankers interacting directly with these incredibly demanding clients, must deeply understand the severe legal consequences of bypassing these controls.
They have to be the bad guys sometimes.
Well, they have to act as guides, steering the client through the secure process without making it feel like a bureaucratic burden. They have to know how to say no in a way that sounds like, yes, I will absolutely set that up for you, and then I just need your final digital signature to release the funds.
Framing is everything. So we have this architectural mapping of every digital endpoint. We have algorithms granting highly regulated exemptions in milliseconds, backed by massive audit trails. And we have strict behavioral guardrails placed on the human relationship managers.
That's the ecosystem, yes.
So how does a bank actually prove to a regulator that all of this works together in practice?
Relentless practical testing. The analytical source outlines a specific mandate for testing these environments. You cannot just rely on a theoretical compliance manual sitting on a dusty shelf.
Right. Theory versus practice.
Banks must actively and continuously test their client portals, their mobile applications, and their systems for remote payment orders.
The text also explicitly highlights card flows and, interestingly, holding company accounts. I imagine in the private banking space, you aren't always dealing with a single individual tapping a phone.
Oh, rarely.
You're dealing with complex corporate structures, family offices, trusts, and accounts that require, multiple authorized signers.
Yeah, testing those multi-signer flows is arguably the most complex part of the architecture because the authentication choreography has to align perfectly across several different individuals who might be in different countries, using different devices, all at different times.
That sounds like a logistical nightmare to test.
It is, but ultimately, if a bank fails to test these areas, they are operating blind. The core thesis of the analysis we are reviewing today is that skipping an authentication step without proper documentation and legal justification isn't a customer service win.
Far from it.
It immediately manifests as a severe compliance risk, a massive fraud vulnerability, and a crippling liability for the institution.
Because if the money vanishes and the regulator finds that the bank didn't strictly follow the SCA delegated regulation, the bank is entirely liable.
100%. The bank absorbs the financial loss and the regulatory penalty. The law is designed to protect the client's assets, obviously, but it is also the strict standard by which the bank's operational competence is judged.
Right. As we wrap up this deep dive, there's a lingering thought I want to leave with you, the listener. The source material focuses heavily on the bank's liability, the technical frameworks, and the legal texts. But think about the psychology of the ultra-wealthy client in all of this.
The client who expects total invisibility from the process.
Exactly. They want ultimate security for their immense wealth, but they demand absolute zero friction in accessing it. When a powerful client yells at the relationship manager to bend the rules, to push a wire through without the authentication app because they're busy or on a yacht.
They aren't just risking the bank's compliance status.
No. They are actively petitioning the bank to dismantle the very vault door protecting their own fortune.
It's an inherent paradox, really. They are fighting the mechanisms designed solely for their own protection.
Which leads to a fascinating shift in the landscape, I think. As these laws get tighter, as dynamic linking and real-time risk analysis become the absolute baseline, we are approaching an era where the ultimate luxury in banking isn't a human bending the rules for you.
What is it then?
It's an algorithm that refuses to let you bend them. The new 5-star service is uncompromising security.
A security that protects the client even from their own desire for convenience. I love that.
So keep that in mind next time you find yourself annoyed by a prompt on your banking app. You wouldn't want the bank to leave the vault open just to save you 3 seconds. Thanks for joining us on this deep dive into the architecture of private banking security. We'll catch you on the next one.